Hello, everyone. Thank you for joining me today on the Sonny Chung Podcast, where I host this podcast and introduce you to different businesses and personal personal development, and also share with you a couple ideas and how to get your financing about real estate and about personal growth. Today, I have a great guest here on the show. He is the SBA King. His name is Bill King, who been in the SBA industry over 20 years. If you're looking about structuring SBA loans, he's also taught CE course, helped countless entrepreneurs secure capital. For people listening to this episode, uh, one one thing you should know about SBA financing before we jump in is it is a government loans, and Bill going to go in depth about this process. Bill, thank you very much to join me on this show. It's been a pleasure. If you don't mind, share a little bit about your background that people don't know who you are and what you do, so our audience have a better understanding who you are and what your process is.
Yeah, no, thank you, Sonny, for having me. I've been in as you'd mentioned, in the business financing space for over 20 years. I actually started in more conventional lending, but still dealing with privately held business owners. Started with the larger banks. I worked for both Bank and Chase for a few years and decided I wasn't a big fan of working for the larger banks at that time. So started working for more regional banks where I really started doing more SBA loans as a part of my job. So what would happen is sometimes a business client would have a need and SBA would be a better alternative than conventional. So I got very good at SBA financing and kind of became a go-to person at our shop for that, and got recognized back in 2014 as the SBA Financial Services Champion for the state of Oklahoma. Have managed SBA teams, have managed regular lending teams, and I'm currently back just doing regular production as a national SBA preferred lender for Dogwood State Bank, who's a strong SBA lender, top 50 lender in the country. And we do all types of deals around the nation, and glad to be here to provide some insight into what we do here in SBA financing. And anything, again, that I discuss is going to be just my opinions and my thoughts. It doesn't represent my bank, doesn't represent SBA specifically. It's just my experience working in the program.
Thank you very much for that disclaimer, sharing your experience in the SBA financing industry. Not a lot of people know about it, and probably they do know, but they don't know how to apply it, right? So, Bill, why is SBA financing such a powerful tool for entrepreneur and small business owners?
Yeah, it's a great question. So one thing that is good for business owners to know is that SBA is not the actual lender. It's an SBA loan program where the SBA is providing a guarantee for the lender, who's either going to be a bank or a non-bank lender that is doing the loan. And you generally have two paths of why you would use SBA financing. One is you're having trouble getting approved for conventional financing for whatever reason. The deal may not have enough collateral. Cash flow might be tight. You may have a credit issue. It might be a startup business. There's something about the credit that makes it where a lender is going to be uncomfortable lending you that money without the support of that extra guarantee. Or it'll be a situation to where you may qualify for conventional, but you're able to obtain more favorable terms using SBA, like having a lower down payment or longer amortization, and that the SBA loan is fully amortized and doesn't balloon. So sometimes with conventional financing, the loan will mature every 3 to 5 years to where the business owner will need to reapply. And some business owners just prefer to just have the loan fully amortized out and they just make their payments. So I've dealt with business owners before that prefer using SBA, and that's one of the main reasons is they just don't want to have to mess with reapplying every few years.
I see. From what my understanding, there's two types of SBA financing. And I want you to give a overview so the borrower or someone interested in it, right? What are the main difference between an SBA 7A and SBA 504 loans? And when should the borrower or a
Sure.
business choose one over the others?
Yeah, that's a great question. You have two main what we call flagship programs. The most common program is the SBA 7A, which we jokingly call the Swiss Army knife of SBA financing, because you're able to do a wide variety of projects using 7A. You can use the loan for buying real estate, leasehold improvements, buying equipment, working capital, inventory, things like that, buying another business. 504 is geared primarily towards buying real estate assets. So that's the major distinction of where you have an overlap, where you're choosing one versus the other, is usually when you're buying a building. So in a case where you're looking at 504, generally a 504 loan is going to have a longer fixed rate, and it's also going to have a longer prepayment penalty. And a 504 loan is actually, and again, we can do a whole talk just about the intricacies of 504. But with the 504 loan, it's actually going to be split into two loans. The first loan will be about 50% of the project, which is the bank actually making that loan. And in a case like that, they will partner with what's called a certified development company, which is a nonprofit entity that partners with SBA that will make the second loan that is anywhere from 30 to 40% of the project. And then the borrower will put anywhere from 10 to 20% down. And the time where they would put more money down would be if it's a startup location, then they'll have to put an extra 5%. And if it's a special use property, like let's say mini storage facility or something that's considered special use, that'll be another 5% discount to the loan amount. So that's why the 504 loan will be anywhere from 10 to 20% down. When you're using a 7A, it's just one loan, and you can use multiple use of proceeds at one time. So sometimes a borrower may select 7A if they're going to be buying a building, and at the same time, they're going to be buying some equipment. They're going to need some working capital. They're going to need various other things, and they want to just lump it all together in one loan. One of the interesting things about that is, as long as the real estate portion of a loan is more than 51% of the project, you can amortize the whole loan over 25 years, to where when you're financing, inventory, working capital, and equipment, usually you would have to do that on a shorter amortization.
Interesting. So can you walk me through, let's say someone brand new and they need startup capital to work on it. It sounds like SBA 7A loan could be a good fit. Can you walk through the process if someone want to apply for the SBA 7?
Sure. So in the example you're giving us, we have someone that's a pure startup. They're either starting a business from scratch, or they're, let's say, maybe getting a franchise, either one of those locations. But the scenario is it's not a business that's operated before. They're starting brand new. So they're going to have to put together a strong business plan and cash flow projections explaining how they're going to be able to make money to repay the loan. So we typically require 2 years of projections along with the business plan. We're going to look at the resume of the client to be sure that they have good experience that ties to whatever type of business they're trying to start. They're going to have at least 10% down and some post-closing liquidity to be sure that they have extra capital to ride the ups and downs of starting a business. And, we'll gather a complete financial package from them, and we'll get a outline that'll usually be part of their business plan of all the sources and uses of proceeds. So what it is that they're applying for, as far as if they're going to be leasing space, if there's build out requirements, if they're buying equipment, working capital needs, you'll add all that up. And whatever the total project is, the borrower will usually need to put at least 10% down. In some cases more. It's case by case, depending on the lender and the project. And then the loan will typically be on a 10-year amortization in a case like that, where you're not primarily dealing with a real estate purchase. So in a case where the collateral is not real estate, like buying real estate, it would usually be a 10-year amortization. And one advantage of using SBA for that, if you could qualify for a conventional loan, would be that typically a conventional lender is going to have a shorter amortization for those asset types. When you're dealing with equipment, receivables, inventory, things like that, it's usually more like a 3 to 5 year amortization if you're going through a conventional lender. And most times conventional lenders won't do startup deals anyway. So you're almost always going to have to use an SBA 7A loan for that type of project.
Interesting. If someone wanted to start it out, it's the best way to go is to apply for an SBA loan to see SBA 7 and see what happened. On the SBA 504, to switch gear a little bit about real estate and business acquisition. For business owner who want to stop renting, for example, and they want to own their own buildings, how does SBA financing, let's say 504, make that possible for them? Would they able to put down 10% down payment, or they have to, what the process? Can you give a brief overview what the requirement for them
Sure.
doing this?
The example that you're providing is actually a textbook, what we call a rent replacement deal, which you could look at both 7A or 504. So let's say we have a scenario where you have an established business that's been leasing space for, we'll say, 5 years. And they either have an opportunity to buy the building that they're already in, that's the best scenario. They can just buy that building. Or let's say that, their rent is going up, they're deciding, I really want to have some of my own equity, or I need a bigger location. So they buy a different building, but it's similar, or relatively equal distance from their location where it doesn't hurt their business too much. And so in a scenario like that, where they're going to buy a building on a rent replacement deal, if they use 504 as you're describing, yes, they can do as little as 10% down, depending on the building type, if it's considered special use or not. But one of the interesting things, if you use a 7A for that type of loan, is a borrower can actually do it 100% finance. Because we can use, and again, this is case by case and bank by bank, but it is technically eligible in the program, that we could use the equity that they've accumulated in their business as a consideration for their down payment for buying the building. So in some cases, they can get away with less than 10% down through the 7A program. And as I mentioned, there's usually other costs associated with buying a building or making a move, to where, maybe they're going to have moving expenses, additional equipment, working capital. And if they roll all that in, you can do that through the 7A program. But the 504 will generally give you a lower, longer term fixed rate. And the good thing with what I'll do for clients when they're in that situation is, I'm at a bank that we're able to do both 7A and 504. So I'll just give them a side-by-side comparison. I'll show them, look, this is how it would look if we go 7A. If you go 504, this is how it would work. And then what I've done before too is you'll have a 504 and a 7A together, to where you'll have one loan for the 504, just the real estate. And then you'll have another 7A loan on a 10-year amortization for everything else. So all the equipment, working capital, inventory, and everything, you do in one loan on a 10-year am. And then you would do the 25-year am with the 504 specifically for the building. So that is another scenario too. So that's why it's probably good for a borrower that's considering those options to work with a bank that has the ability to do both. So you can show them, each scenario and which one might be better given their situation.
I mean, the two programs sound fantastic, and sometimes people get confused, from SBA 7 or 504. Let's go to this particular example. Okay, when someone buying an existing business, for example, that include real estate, how would SBA help bundle everything together? Goodwill, equipment, inventory, etc. Can you see which program is fit in that kind of example?
Yeah, I'll give you a real life example. I was looking at a deal a couple of weeks ago that a client was buying a manufacturing business that included real estate for about $5 million. And $3 million of that was the real estate value. $2 million was everything else: the goodwill, the equipment, the enterprise value of the operation. So in a scenario like that, where you have, in essence, 60% of your use of proceeds is real estate, and the remainder is, goodwill, equipment, everything, you're able to do the whole loan on a 25-year amortization, like we were talking about earlier. So you can do that with business acquisitions as well. Same scenario, let's say that it was flipped the other way, where you were buying a $5 million building plus business combined. And let's say in this case, the building was only worth 2 million and everything else was worth 3. Then you would have to split it into 2 loans because the real estate portion is not more than 51%. So you would do the real estate loan. So you'd have a $2 million project buying the real estate. So your loan would be, let's say, about $1.8 million. And that would be a 25-year note. And then the loan for the $3 million business acquisition piece would be on a 10-year amortization, let's say 2.7-ish. So you'd split it in 2. So the determining factor of whether you'd have to split it is whether or not the real estate portion is more than 51% of the total project and use of proceeds.
So can you dive deep on how, can you explain the requirement for the 51 owner occupy when buying the building? Because sometimes you don't know how to structure this thing, right? So do they have to occupy over 51% and then lease out the rest? Is that how it's worked?
Yeah, well, let me clarify a couple of things because we use 51% for so many different things. What I was talking about for this was 51% of the use of proceeds of the project. In any case, whenever you're dealing with any SBA financing, whether it's lease space, whether it's buying a building, anything, it's intended for owner-occupied operating businesses. And where the real estate rental portion, if you have a portion that's leased, is secondary to the operation. So it's going to be, if you're using 504, sometimes you have to do 60% owner occupancy versus 51%. But the intent of the whole program is that we're dealing with operating businesses, that the main purpose of the building is to run their business. And if they're going to lease out the other space, that's fine. But we expect the cash flow to pay the loan to come primarily from the business operations, and the rental income will complement that. So the way that you establish what is, owner occupied versus not owner occupied is obviously the portion that they use for their business. And also they are able to use common areas. So if you have like a mutual reception area, if you have a conference room that they can use and tenants can use, if they have restrooms that they can use and tenants can use, that also can be considered part of their occupancy to make the 51% minimum to make it a owner occupied building.
I see. Okay. That's very interesting. So if you're watching this, I guess you have to watch a couple of times to get all this golden nugget from Bill. Okay, that's an overview about the program, but I think the next step is that the qualifying process, right? The underwriting process, and the mistake that most borrowers don't understand. One thing is what I've been researching is the credit elsewhere test. And why is that such a critical part to get SBA approval? Can you dive on what is the credit elsewhere test?
Sure. What the idea of the SBA program, and the reason why it's used and was invented, in my opinion, was to help small businesses, small to medium-sized businesses, obtain financing when they otherwise couldn't. So to prevent the program from being abused by people that could use it when they can get financing anywhere, they had the credit elsewhere test, where we have to document in our file that the borrower could not have obtained financing either at all or on similar terms to what we're offering, a reasonable terms, without using the SBA guarantee. So that's intended to preserve the dollars in the SBA program for business owners that it actually can help, so that they actually can use it. And that is one of the tests that we have to go through when we're doing our underwriting. And you were talking a little bit about underwriting. One thing that I'd like to mention that is a misconception that a lot of business owners have is the SBA rules are, when I'm teaching this in groups, I'll have a big whiteboard and I'll explain the whiteboard represents everything that we're allowed to do within the SBA rulebook. And then within that board, you could draw a box for, let's say Bank of America or Chase or Wells Fargo or our bank, any bank. Every lender has their own criteria within the SBA program that's not going to be exactly the same. So it is entirely possible to go and apply with one lender and they decide they're not interested in your loan, but you're still eligible as long as you qualify. And you could come to another lender and they may approve your loan when someone else didn't. So a lot of times if a borrower gets turned down by, let's say, a larger bank, they think that the SBA turned them down, when in fact that's not the case. That bank decided they were not comfortable even with the SBA guarantee to approve a loan. So you still could qualify if you go to someone else, which is, I was out as a consultant for 4 or 5 years where all that I did was help borrowers find financing that maybe they had trouble finding it in one place and we placed it somewhere else. And in the SBA world, we all kind of play well together because we all have different credit boxes. We're all friendly competitors for the most part.
Okay, so pretty much the approval and the process underwriting is based on the bank and also the credit worthiness from the borrower. So that lead me to another way of looking at this, or how do we frame this question? What's a common mistake that borrower made that slow down or kill the SBA deal?
Yeah, that's a good question. There's probably a couple, 3 things that I commonly see. One is borrowers generally start later in the process than they should. They should start very early before they're already leasing a space or before they've committed to too many things. They should at least start the process of getting ready for financing. There's small business development centers which are funded by the SBA that a small business person can go to get ready for an SBA loan. They'll help them put their package together. They'll help them put together a business plan. And if anyone listening to this, if you just look up SBDC in whatever county you're in, you can see who covers your county. Like out here in Collin County, it's covered through Collin College. We have the Collin SBDC. And usually they're associated with some type of community college or some type of government office. And again, this is subsidized by the SBA to provide low cost or free tools to business owners to help them obtain financing.
Is that free service?
I'm sorry, sir?
Is that a free service or do they have to pay for that service?
Usually each SBDC has various programs, training and services that they provide. Many are free, and the ones that aren't free are generally very low cost compared to having that same service provided by somebody else.
Got it.
So that's why I say that it's subsidized by the SBA. But many of their services are free. They have workshops all the time. And they also, they can help you with a lot of good data to study, if you're looking at starting a business or expanding to see if maybe there's a lot of competition in that area or whatever market data they have. They have access to a lot of good information. And so one thing that I recommend, and particularly if you're talking about like newer business owners, people starting up or just getting going, the first step I would have them do is find their local SBDC and get in contact with them. And that will help them with the next step, which is putting together a basic business plan, putting together projections, putting together your financial package, which typically is going to consist of 3 years of your tax returns. Even if you don't have a business, you're going to still gather your personal tax returns for the last 3 years. You're going to have a personal financial statement showing what your assets and liabilities are, and if you have income from other sources, explaining what that is. It's also helpful when you are starting a business if you do have some outside income to supplement it while you're getting up and running. So I'm asked that question a lot: is it better to just quit and then start a business, or keep something going and do the business on the side? Or what I've seen too is you'll have partners where you'll have 2 or 3 partners that are coming together to do a business, where maybe one partner will be running the day-to-day and the other 2 will be involved, but they'll still be retaining some outside income that helps the overall cash flow. Because that's the biggest challenge, is transitioning from having one source of income to getting the business up and running to be profitable and provide income for everybody.
Okay. That's awesome. What you're sharing is really helpful for a lot of people who has to listen to it. So when does the SBA financing not make sense for the borrower?
Well, I mean, it depends on their situation. So the type of business that qualifies, it's got to be a privately held company. It's got to be for profit. So you can't be a nonprofit business. Your primary source of income can't be rental income. You can't be gambling or speculative things. So, once we've eliminated all the things that don't qualify, if you're saying, okay, now you've got something that qualifies, when is it not a good SBA deal? There's going to be cases where you can't get approved, so you've got to look through. And I'm going to plug my book that's available on Amazon if anyone wants to read it. It's called the No Bullshit Business Finance Guide, where I explain in that book the 5 C's of credit that every lender looks at when they're analyzing financials. So you're going to size yourself up when you're applying for an SBA loan, and maybe you can't get approved if you're weak in too many areas at one time. If you're, the 5 C's real quick are character, which is generally representing your credit worthiness. So it'd be your credit score, if you've been sued, if you have any legal problems, things like that all come under character. Then you have capacity for repayment, which is in essence, how are you going to pay this back? Is it projected revenue? Do you have historical revenue that supports it? What income is going to support this payment? What's your primary source of repayment? Then you have available collateral. If primary source of repayment doesn't work out, what do we have to fall back on? Are we going to take your house? Are we going to take back the equipment? What are we taking as collateral? Then you have what we call capital, which is in essence your balance sheet. What personal assets do you have and personal liabilities? When you're a startup, that's going to be a lot of what it is, personal. But as you're growing as a business, you also have your business balance sheet of, okay, what assets do we have? What are our liabilities? How much liquidity do we have? Do we have money that we can invest and then have a little bit left over to ride the ups and downs of the business? And the last C is more general, where you're talking about the conditions, which can be economic conditions, the geographic area that you're in, the industry you're in, what your management team looks like. All those things come together with the other C's to say, okay, is this a deal that we think is going to get done? And so when we were talking earlier about different banks having different policies, some lenders will only lend in certain geographic areas. Some lenders will not lend on different asset types. For example, if you're doing a hotel motel deal, some lenders just don't like those. If you're doing restaurants, some lenders just don't like doing restaurant deals. So depending on the type of project you have also affects your financeability, if it's a higher risk area, and if your experience is relatable to that. So what I would say is when you're analyzing it, talk to a lender or two, and you may even ask if someone goes to the SBDC first, go through those 5 C's and analyze your deal yourself, or they can call me. And we'll do a quick analysis and say, look, you're low on 3 out of 5 C's. This deal's probably not going to get approved. So when you have a case like that, you look at, then I can bring in an outside partner that strengthens my weakness. So for example, I've had cases before where I have someone that's a great operator. They know the business inside and out, but they have bad credit. They have no assets. They're weak. So they may bring in a financial partner that has a strong balance sheet, has outside income and good credit, but doesn't know anything about running that business. So they combine their resources, and the lender might get comfortable with a combination of that partnership, where if each one applied individually, they might have both been turned down.
Interesting. Yes. Leverage someone weakness for their strength. So I love that. Well said, Bill. So let's say, let me go dive deep when what you just mentioned here. For a first-time entrepreneur, have limited financial history, credit, etc., what should they prepare to increase the approval on for SBA?
One thing I would recommend that you do right off the bat is get a free credit report. And there's all sorts of sites out there, freecreditreport.com, whatever, where you can, and I believe you can reach out to any of the major credit report providers, and they can send you a report once a year for free or for a small charge. So I would get that first to see what story is being told when the creditors pull your credit is step one. As I mentioned, it's helpful to talk to the Small Business Development Center, research whatever business that you're trying to start, put together your basic financial package that I outlined earlier, and really look at your stuff and ask yourself the questions. How does this look to me? Does this look like something financeable or something odd in your history that you need to explain? Another thing that's actually important on the SBA forms, there is a box that needs to be checked. I believe it's on form 1919, or it might be on the PFS, that says, have you ever filed bankruptcy? Another misconception that a lot of people have is that if it was over 10 years old, that the bankruptcy doesn't count, which is not the case. So I've had borrowers where they had a bankruptcy 20 years ago and they checked no on that box because it was a long time ago. They thought they didn't have to. The question is, have you ever filed it? If it was further back, so you still have to say, yes, I did. I filed 25 years ago, 20 years ago, whatever. We can usually get around it. We just have some additional paperwork we have to fill out. We have to do different forms, and we have to do a letter of explanation. Okay, this is what happened. Now my credit's fine, but I had this problem before. But be very honest and transparent on the application is one of the things that I recommend, because they're going to find out. And
Right.
it's better to be upfront of whatever weaknesses you have and explain why it is you still think there's a deal there than thinking you're going to hide something and they're not going to find out about it. Because if they find out about it later, it's going to be a lot worse than if you just brought it up front.
So
And that goes for the advisors too. I mean, for the realtors or business brokers that I deal with, I like all the hair up front. Let me know what we got and we'll figure out if there's something we can do.
exactly. Transparency, authentic, and just be open when you try to applying for the loans. It save a lot of people time, and just make sure you act in good faith. I think that's a great way to start in any businesses when you want to get a SBA program in your favor. So, Bill, I really appreciate your time. I have a few more closing questions for my show, but I think there's a lot of golden nugget that you share with us. And if you want to check out Bill's book on Amazon, I'm going to put the link below so you can click on it, so you can watch, you can order his book and support him, and hopefully there's some value in his book that you can help yourself, right? So, Bill, there are a few questions, a little bit personal and professional development. That's the theme of my show. Even if the business side is good, but also the personal side as well. So, Bill, what one lesson you wish every entrepreneur understood about money and financing?
Yeah, no, that's a great question. I think that every entrepreneur should learn basic accounting and finance so they understand really how to read financial statements. Mm-hmm. And I'm not talking about, getting a CPA or getting a degree in accounting. I'm saying you get some very basic coursework where you understand how debits and credit work, and you understand, what story the income statement is telling you, what story the balance sheet is telling you. There's so many entrepreneurs I've met over the years that are great operators. They know how to run their businesses, but they don't understand the story their financials are telling. And I think that is something that is undervalued, in my opinion, that I think it would be great for business owners to make that a priority, even, just sitting down with their accountant and just making sure they clearly understand, like I said, what story are your financial statements telling? Because finance is a language. It's telling us something. When we look at it, we're saying, okay, is this a business that's trending up? Are their profit margins good? Are there large variants of expenses that jump around? How's the net profit? Do we have large compensation officers? There's all these things that we look at. So I think it would help the business owner to understand what a lender or even an investor or anybody that's looking at their business, what they're looking at and what they see when they're reading the financial statements. I think that'd be very good for business owners to learn that.
Yeah, I think that's a great way to put it. You got to know, become financial literate, so you know what's going on, right? Because some people don't have it. That's why we have some business succeed, some business fail. Just let's say that what advice, one piece of advice would you give someone listening to this podcast or watching this who's scared to start? What would you say to them? They want to start a business, but they think like, okay, I have all this chip on my shoulder, like I don't have my credit or bankruptcy or old taxes, et cetera, et cetera. So what one piece of advice you would give a young entrepreneur or someone want to start out that's scared to do so because they think they have all this thing against them?
Yeah. It's interesting, when I talk with business owners every day, sometimes they'll want all the lights to be green before they start, as the saying goes.
Yeah.
And, I've heard a saying that when you take the first step, the path will open up to you. And a lot of times what will happen is, they're not going to know everything before they take the first step. So when you take the first step, if you do what you can with what you have is what I always tell people. You do what you can with what you have starting now, and then you can continue to grow from there. So I always tell entrepreneurs to take whatever the most basic step is they can. To your point, if they've got, bad credit, they review their report and see if there's anything they can do to improve that. If they don't have very good transferable experience for an industry they're trying to get into, learn whatever you can about that industry to educate yourself. If they need help learning how to put projections together or a business plan, use a local SBDC for information, or buy a book. There's plenty out there for $10 on Amazon of how to write a business plan. So what I would say is just start doing something, because what people tend to do is they tend to get overwhelmed by, there's so many things that need to be done. But what's that saying? Journey of 1,000 steps starts with the first step. So they just need to start doing something and start with the most simple thing they can do, and then the next step will open itself up to them.
I love that. I love that. So you based on what you're doing, over 20-year experience, you talk to countless business owners, you see successful stories, you see failure stories. So in your journey in the SBA process, what does success mean to you now compared to when you first started in this industry, based on what you see in your career?
Yeah, I was thinking about that. So when I first started, of course, I was a young kid. I'm just trying to get loans approved, trying to find clients. It's more just getting deals in. And it's developed over the years to where I'm really more of what I consider myself a guide and a trainer, to where I'm trying to walk the business owner through a difficult process. Like I had dinner with one of my clients last night in Oklahoma City that was a retired exec that's buying a franchise business out in Florida. And he's been very appreciative of the fact that I've just kept him calm through the process, because there's so many steps, in getting an SBA loan done. And we were joking about this because I would see an email come from our closing department to him. And I knew that he was probably about to blow up because they were asking him for something that he'd already supplied. So I'd shoot him a text real quick, say, hey, calm down. We're just going to take care of this. So I think that the value that I provide now is, having been there, done that, and wrote the book, as they say, I can provide some calm that, hey, it's okay. The process, this is how this process normally is, and we're going to hit some bumps in the road. And I think that calm that I provide is helpful, not only in dealing with the business owners and their consultants, but even younger bankers that maybe don't know a lot about SBA, or are just getting started in the business.
Wow. Yeah, it's a lot of young entrepreneur coming up, new banker coming up, and if they listen to it, hopefully they get some wisdom out of it. And again, I'm going to drop that link of your book on Amazon, so get some, share your knowledge with everybody. I have one last question for you. And I appreciate your time and sharing your knowledge with us, me, and the audience who listen to this. What's the next chapter for the SBA King?
Well, the next chapter is I am hoping to write another book or two in the near future.
Nice.
And I've been doing a lot more speaking, like what we're doing today. I was speaking on another event earlier this week, and I spoke on a panel or two last week. So I really want to get out there and educate business owners, business advisors, and even banks, banks and bankers. There's a ton of bankers that really don't know a lot about SBA. Educating them what's available through the program, and just provide more of that guidance of, what I've learned over the years while I'm still out there trying to get deals done.
Wow, that's good. But giving back, sharing your knowledge, that's all we can do. Bill, thank you very much for sharing your knowledge, your experience, and a lot of entrepreneur, business owner will benefit from this conversation. For everyone who listens to this, if you consider buying, building, acquiring businesses, or expanding your operation, SBA financing might be the key to unlock the next level for your business. So don't be afraid. There's some guideline, there's some help out there you can seek. Follow Bill King on LinkedIn, Facebook, and connect with him if you want to learn more about SBA loans. This is the Sonny Chung Podcast. Stay focused, stay consistent, and keep building. And thank you for joining us. We will see you in the next episode.
Thank you.